Thank you, everyone. Those who could join us on a Friday evening where the sun is shining very bright in Luxembourg. So, just wanted to say thank you for joining this session on NRI, which we all are non-resident Indians, and giving an opportunity uh, to our fellow colleagues, our chartered accountants here in Luxembourg, but also the wider Indian diaspora people who are also very interested into the topic that we are covering up, which is impacts everyone, like the taxation and investments to both of them. To both the topics are very close to all the participants, including the people living in Luxembourg. So, just to give a perspective, in today's session, we will try to cover up the matters of NRI taxation matters based on the last financial budget that came out, uh, whereas other topics related to NRIs was covered up in our previous two knowledge sessions related to NRI taxations, which I will also share the link for recording to our participants after this webinar, which will give us a kind of a third in a row of multiple sessions. So, uh, followed by this as an agenda, I would like to introduce our NRI tax expert, Mr. Sagar Soman. Then he would present up the new provisions of our which came up out into the budget law of 2025 recently. Then we will talk about our new investment opportunities that is opening up. India is growing. So while we are very active all in our investment financial matters, if not, then we will show some new avenues led by our two specialists from Philip Capital, Mihir and Nishit, who have kindly agreed to be part of this session as well. So said that apart, I will leave the floor to Sagar to start his deliberation for the participants. Thank you.
Thank you, sir. Good evening, everyone. I would like to sincerely thank our ICI Luxembourg Chapter Chairman, CA Anjani Ladia, sir, distinguished members of the ICI Luxembourg Chapter, and all the attendees for joining this insightful session, especially on a Friday evening. Before we begin with the income tax changes, it's important to clearly distinguish between two significant tax updates impacting taxation in India. Firstly, we have the Income Tax Bill of 2025, which will become effective from 1st April 2026. So there is still 12 months more to go for the new income tax bill to come into effect. This will replace the Income Tax Act of 1961, and many provisions regarding taxation are going to be simplified in the new income tax bill. The second one, which is the usual Income Tax Act of 1961, which gets updated every year through budget, that is by passing of a Finance Act. So the major changes that we are going to talk about today are the Finance Act changes, which will be implemented from 1st of April 2025. So for the return that we file in July of 26, this will be applicable, which are the changes impacting from next week, actually, 1st April 2025. Now, quickly addressing some widespread misconceptions going around in social media regarding the new income tax bill, that it will tax NRI's global income or require them to disclose foreign assets in India, or they will tighten the tax residency rules. All these things are not there in the new income tax bill. Basically, everything remains same regarding the residency rules or disclosure requirements and all. All those foreign assets disclosure are applicable only to resident Indians and not to NRIs. So if you are NRI, then you don't have to disclose your foreign assets, or your foreign global income won't be taxable unless there are certain provisions where if you don't get taxed anywhere else, then deemed residency is there and all. But in usual cases, it won't happen. Now, let's focus on the major changes that have happened that are going to start from 1st April 2025. The first one is the most welcome change, wherein the taxation is significantly reduced. So we have new tax slabs under the new regime. So old regime remains the same as before, but under new regime, the tax slabs have been changed significantly. Now the first 4 lakhs is completely exempt from tax. After that, every increase of 4 lakhs, the slab rate increases by 5%. And the maximum slab rate above 24 lakh income is 30%, which was as before. So the maximum slab rate is same, but the different, gradual taxation has been relaxed a lot. So this is the tax structure now under the new regime. As I said, the old regime, which is the optional one now, it remains the same. So not much benefit. Specifically, we have seen in case of NRIs, wherein they don't have a lot of deductions to claim under ATC for insurance or any other investments, or specifically for home loan and things like that. So for them, anyway, the default regime, which is the new regime, has been beneficial for past couple of years or so. And now after the relaxation in the slab rates, it has become even more attractive. So maximum cases of NRIs, I think, will opt for the new regime itself. Then there is another section, 87A, which deals with the rebate. Now, this section is specifically not for NRIs. So, under this section, if your slab rate income, which is the regular income, is up to 12 lakh rupees, then you don't have to pay any tax. This excludes the special rate income. Special rate income is the capital gains which are taxed at the special rates. So it excludes such type of income, but for other income which is taxed at the slab rate, the rebate is available. But this is available only to the resident individuals only, not for NRIs. So for NRIs, still, beyond 4 lakh rupees, there will be tax liability. And this 87A limit has been extended for the new tax regime to up to 12 lakh rupees. It is not for the old regime. So again, here rebate is more beneficial only for the new regime. Then another change has happened in the taxation of house property. Here, Section 23 of the Income Tax Act has been amended. Earlier, if you had two properties, then you could claim up to two properties as self-occupied, subject to certain conditions. Now, those conditions have been waived off, meaning that if you have two properties in India which are occupied by your relatives, parents, you don't have to pay any tax on the notional rent that you needed to disclose. You just can show it as a self-occupied property, and the annual assessable value will be nil in that case. So there won't be any tax on up to two properties which can be claimed as self-occupied, and the conditions have been removed. This one is for the ITRU, which is under section 139(8)(a). Now, if we take an example for the last financial year, which was 23-24, the assessment year for that is 24-25, meaning on 31st March 2025, the assessment year will end. Now, ITRU said that up to 2 years after the end of assessment year, if you have missed reporting any income, you can come forward and pay additional tax. This is not applicable for refunds on TDS and all those things. This is only if you want to come forward and pay additional tax, then you could do it up to 2 years. But now this has been extended to 4 years. So we will take an example for the last year, 23-24. The due date to file returns for non-audit assessees was 31st July. Up to 31st July, you can file a regular return. If you missed that, or if you had filed but there were certain corrections to be made, you can still do it. You could still do it by 31st of December 2024, which is the end of calendar year. Till that point, amendments were allowed. But if you missed even that time, then if there is a tax liability, you could come forward and file a return up to end of 2 years of the assessment year. So for 23-24, the assessment year is 24-25, and 2 years from the end of that is 31st March 2027. Up to that point, last year's return could be filed. Now this has been extended to up to 4 years. So for the last year return, if you have missed it, you can still go ahead and file till 31st March 2029. This is subject to obviously paying some additional tax liability. So when you come forward and disclose additional income, there would be some interest component as well. The total additional tax liability would be 25%, 50%, 60%, or 70%, depending on when you are filing the return. So for first 12 months, it is 25% additional tax on whatever tax plus interest you are going to pay, and likewise. So this is basically for people to who feel that there would be a scrutiny assessment or there would be some penalties in case of missed income reporting and all. So for them, this is a window of opportunity to come forward and file their tax returns. Another welcome change is in the TCS under LRS. So here the limits have been extended. Earlier, whenever family members of non-residents residing in India, they make any outward remittance to NRI under LRS scheme. LRS scheme gives you a 2.5 lakh dollars per year limit per PAN, and this is applicable to minors as well. So whenever a payment is being made to a non-resident, this would have to go through the LRS route. Under LRS, beyond 7 lakh rupees, there was a TCS. TCS was 20%. Now this 7 lakh limit has been extended to 10 lakhs. So up to 10 lakh rupees, there is no TCS. Beyond that, the TCS would still be there. Second is for education loan. If you have taken any education loan for studying overseas, then there was a TCS of 0.5% beyond 7 lakhs. Now this has completely been waived. So if you have taken any education loan from a bank, and if the bank is making any payment towards your towards the disbursement of the education loan for payment of your overseas fees and all, there won't be any TCS anymore. So these are the major changes impacting NRIs starting from 1st April 2025. Any questions that you may have, we will try to cover at the end of the session, or else you can write to me. These are my details, and then I'll personally get back to you on the queries. We have with us Mihir Shirgaonkar and Nishit Shah, who are, fund industry experts. They are from Gift City, so they'll be explaining certain investment avenues which are new and upcoming through the Gift City. So I'll just pass it on to them. Thank you so much.
So thank you so much, Sagar sir.
Yeah.
Honestly, this session of yours has been a very good learning for me as well. So I've quite literally taken a lot of notes, especially with the entire Income Tax Act 1961 getting phased out. So I think very large scale implications. So thank you once again, and I really welcome all of you. Thank you so much for joining us on a Friday evening. So I'll just share my presentation. I'll share my screen just a second. Yes. So I hope my screen is visible. But
Yes, Mihir.
as yes,
Yes.
so as a standard practice, we begin with a disclaimer. So we are definitely talking about investment avenues, and again, this is no guarantee for any investment return. So investment returns are subject to market risk. So the standard disclaimer. So we represent the Phillip Capital Group. Currently the firm that we will be speaking about is Phillip Ventures IFSC. But a little bit about the Phillip Capital Group. So we are headquartered in Singapore, and this is the year where we have completed 50 years as a group. So what really started off as a single product on one Phillip Street in Singapore, and hence the name Phillip Capital, today has quite literally blossomed into a financial services firm which has a presence in more than 15 countries globally. And we have largely been dominant in the Southeast Asian part of the world. So Singapore, Hong Kong, India being the largest businesses, and we have a presence in regions right from Australia. Okay, there is Japan, Thailand, Vietnam. Some presence in Turkey, and we also have a growing presence in the western part of the world as well. So there is UK, there is Spain, and of course we are a futures broker in the US as well. So globally, as a group, as I said, we completed 50 years this year. And we've been primarily into the financial services. As a group, we are collectively managing more than $50 billion of assets under management. That is something which is there to our credibility. So as I mentioned to you that India is one of the largest businesses for the entire group. So our journey in India again has completed 25 years in 2024. So we started off as an institutional broker, but over these 25 years, we have also entered and into different other facets of financial services. So while we have a very strong institutional broking business, with of course research as being one of our strongest backbone, but we are also servicing clients across various asset classes. So right from commodities, currencies, futures and options. We have a very fast growing fund management presence as well. And that is exactly what Nishit and I are here to discuss with you. But fund management, as I said, is really backed by a very strong research team. So in India, we are more than 35 members as research analysts. And these are analysts who, on an average, have more than a decade of experience in their respective areas that they cover. So our analysts are rated anywhere between number three to number one in the respective sectors that they cover. And that has exactly been the very sole reason why fund management as an activity has come very naturally to us. And this is exactly where Nishit Kia comes into picture first, because Nishit heads our India PMS business. So he has a more than 8 years of very consistent track record in portfolio management. And the testimony to this fact is that the PMS strategies which Nishit has been managing under SEBI licenses have again been ranked numerous times as one of the best performing multi-cap strategies. So, we've have been very consistent in our objective of long-term wealth creation. So this is, the entire fund management team. So, as I did mention to you, Nishit. So Nishit, comes with nearly 2 decades of experience in capital markets. And so Nishit is very ably assisted by Ankush. So Nishit and Ankush manage the India-based strategies. Nishit is also the investment strategy for the India-focused fund that we have set up in Gift City. So a larger portion of the discussion will be our Gift City presence. And when we speak of Gift City, so that's where I come into picture. So my name is Mihir. I joined Phillip Capital 4 years back, and the entire objective for me to join this organization was to set up the entire Gift City business. So currently, I head the fund management business in Gift City, the alternative investments division, as we call it. And I am also the principal officer for the Gift City piece, and hence I am based in Gift City. So I again come with over a decade of experience in capital markets. So 6 years in the mutual fund industry, and of course 4 years at Phillip Capital. So that is how my progression has been. And what I really share in common with all of you is that I'm a chartered accountant and very passionate about the study groups of chartered accountants. So I was just telling Anjani sir that I was for the longest stretch of time associated with the capital markets and BFSI study group by the CA Institute in WIRC. So typically in BKC Mumbai. And that is exactly so this particular forum quite literally feels like homecoming. So, just to introduce Gift City to all of you, because all of you have definitely heard about Gift City at some point in time, especially when the union budget gets announced. So, with every passing year, Gift City definitely gets a reference, a mention. But what is the entire concept of Gift City? So, Gift City, at a very physical, at a very infrastructure level, it is an integrated smart city. But the true value proposition of Gift City is that it is envisaged as a gateway, across different markets. Uh, uh, we-
बर्ड्स
so,
किधर है पूजा
yeah,
है
correct. Hello. Ah, so, so very quickly, as I said, so the entire value proposition of Gift City, especially for non-resident Indians, is that Gift City is envisaged as a gateway between India and the global markets. So the implications of Gift City are actually twofold, or should I say threefold. First is that Gift City is a very effective means through which a lot of local investors can access global markets. But the larger piece, and which is precisely why we are having this discussion, is that Gift City is also a jurisdiction where a lot of non-resident Indians can actually access the Indian capital markets. And then a smaller piece is that a lot of non-resident Indians can also access the global market. So we really call it a V-shaped kind of a route. And what really makes Gift City very, very efficient is the fact that Gift City is governed by a completely different regulator, which is called as the International Financial Services Centers Authority. So this is a unified regulator. And it is because of this unified regulator coming into existence in 2020. Gift City is essentially completely distinct from SEBI and RBI jurisdiction. Uh, yeah. So just one second. Yeah. So the entire advantage of Gift City regulator IFSCA is that Gift City is really envisaged, or Gift City is really on its way to implement the best possible practices, because Gift City in turn is India's response to a lot of financial services centers which other regions like let's say a Singapore, a Dubai, a Luxembourg, or a London have. So, because all these regions have their own financial services centers, I think the time was very, very ripe for, Gift City to actually, or India to have its own international jurisdiction. What it means for non-resident Indians such as yourself is that number one, you have access to the Indian markets through an offshore jurisdiction. That is number one. An offshore jurisdiction which is completely dollar denominated. So, that really enables you to have a very, very seamless access, in terms of your banking transactions. And more importantly, it is a jurisdiction which is actually managed by an Indian regulator. So that really adds a lot of safety net and a lot of comfort. And the point number three, which is seamless access to markets. So this is exactly where the Gift City value proposition really plays out to non-resident investors. So first is the implications of the regulatory framework of Gift City is that the investor onboarding in Gift City for different investment avenues is very, very light touch. So unlike non-resident Indians directly investing into the Indian markets, let's say through SEBI route, so they are, definitely saddled with a lot of regulatory requirements. So they need to have an onshore bank account over here. They need to, touch base with local bankers over here. They have to comply with the requirements of either the PIS route of RBI or, maybe the FPI regulations. But all that gets completely eliminated if they are interfacing with a Gift City based entity. Because here the investors are actually interacting with a foreign entity. And to that extent, all the investor onboarding, the client onboarding regulations. So all of these are very, very light touch. Investors, don't like. I mean, the biggest value proposition is that the investors really don't have to open any separate bank account in Gift City. So investors, sitting in, let's say London, sitting in Europe, they can directly do a dollar to dollar fund transfer into our Gift City products, or any Gift City product for that matter, and that's about it. Of course, Gift City is very, very particular when it comes to, the client due diligence, the AML CFT checks. But again, those are, very, very light touch regulations. All this really adds to the credibility of Gift City in providing the operational convenience to investors. Which also brings us to the next topic, which is, of course, the taxation regime. So this is where certain myths about Gift City could also be addressed. So normally, whenever investors or whenever people speak about Gift City, investors are always talking about the tax benefits of Gift City or tax exemptions. So yes, tax exemptions are there, but they are not available to all the investors per se. Definitely investors or entities setting up shops in Gift City, they definitely enjoy the tax exemptions, but again for a block of 10 calendar years out of 50, 10 financial years, I'm sorry. But of course, depending upon the investment product, the taxation exemptions for NRI investors are definitely there. But one thing, is for sure that whether the investment product is taxable or not, what is really advantageous is that the NRI investors don't have to really get into the implications of tax compliances, because Gift City actually doesn't even require investors to have a PAN card. And because whenever there is no PAN card, so non-resident Indians, even if they are generating any income in India, but through the Gift City route, so they don't have to get into the nuances of income tax return filing and other things like that. The advantage is that the returns come to them and they will be adjusted for taxation. So that again makes Gift City very, very convenient as an investment avenue. So, here, again, just stating the obvious. So, if we actually represent Phillip Ventures IFSC, which is the Gift City arm of Phillip Capital. So, we are domiciled in Gift City. Our entire idea is to evolve a range of products, and currently, we are servicing clients across different countries. So, the licenses that we hold are the fund management entity under which we are managing the global PMS, the global and the India focused AIF. Then we are also offering investment advisory, and also we are a registered broker in Gift City. So here I will, very simply run through the slides. So again, here are just some statistics over here, but I think the audience, for the audience here, it is just me stating the obvious that why would anyone consider global investing? So we definitely recognize that the way world markets are really evolving, especially in recent months, we realize that one market does not consistently outperform. You have different markets providing different pockets of opportunities across different time frames. So if you really have an investment solution which can help you capitalize that, then I think you can really achieve your investment objectives better. The second slide may not be directly relevant for NRIs, but definitely for resident Indians. So again, this is the performance of a Nifty 50 versus the S&P 500. So in Indian rupee terms, for a resident Indian, the investment performance is actually a function of not only the foreign or the S&P 500 returns, but more importantly, it is also a function of essentially the dollar depreciation. So, different currency risks and opportunities play out over a longer period of time. And the more the local currency is depreciating in dollar terms over a longer period of time, the better is the wealth creation. So, that is one avenue. What we're really looking ahead of us. So again, very, very quickly, not to really elaborate too much, but going forward, there are certain trends which we are observing. With the kind of policy, the trade policies that are being announced, we can see that globally businesses are getting reoriented. A lot of supply chain realignment is happening. A lot of trade wars are happening, as we see. Technology is playing out very well. So, today nobody is really talking about investing in technology as a sector, but technology as an element has completely disrupted different businesses, and that is also providing investors a lot of investable opportunities. So, that is something which really enables investors to consider having a global portfolio to capture the opportunities coming from what we call as the trends of today and the ideas of tomorrow. So a very, very quick introduction about our product. The global PMS that we are offering in Gift City is called as the Phillip International Pioneer Portfolio. So as I did mention to you, we have a fund management entity in Gift City. So one section of products is where non-resident Indians are able to access Indian markets, which Nishit will cover. But on the other hand, there is also a product which is actually enabling investors to access global markets through the PMS route, and that is the Phillip International Pioneer Portfolio. The entire idea is to achieve capital appreciation by allocating to various geographies, sectors, and businesses, which we believe will grow over the medium to long term. So this is a product which is investing into US listed ETFs, equity ETFs. So, these are, essentially separately managed accounts. The minimum ticket size for the product used to be 1,50,000 US dollars. But now the minimum ticket size has been brought down to $75,000. So again, that has made the product all the more accessible. And this is not just for our products. So all the global PMS products, the minimum ticket size has been brought down. So this is a product which is, again, we have a very, very strong research team in-house. So while the global teams of Phillip Capital are there, but we have developed our own research capabilities, which really enable us to capture various trends, various opportunities happening in different parts of the world. And that is how we are able to achieve our investor objectives. So this was a very quick introduction about the global PMS. And now I would really like to pass it on to Nishit, who will essentially be covering the India-focused AIF. So thank you so much once again for your patient listening, and over to you, Nishit.
Yeah, thanks, Mir. And guys, this is Chamomile Tea. I know it's Friday evening, so it's not something that you guys are thinking. So yeah, thanks everyone for coming on this Friday evening.
Right.
Mir, if you can stop sharing, I will start sharing my.
Is it? Otherwise, I could navigate. Anything is fine. You can let me
No,
know.
I will share.
Sure, sure, sure. Yeah. All right. Yeah.
Okay. Yeah, so what I will do, I will try to keep my presentation as brief as possible, and we'll talk about few pain points and why one should look at investing into India. I would not spend actually too much time on why India as well, because all of us know a lot about India. In fact, when I travel a lot for presentations globally, and most of the time I have to skip because today, because of the WhatsApp universities, YouTubes, actually the NRI diaspora knows a lot more about India than we ourselves out here sitting here. Yeah, so that is what is surprises me sometimes. But of course, it's what we believe truly is the next decade belongs to India. Okay, and these are the reasons. Yeah, so all of us know about these three Ds that have been helpful for India for a very long period of time: democracy, demographics, and demand. Okay, but in each one of them, yeah, see, of course, democracy, we have a stable government which is pro growth, that is known, but it is actually the demographics and the demand that you guys would be surprised. Yeah, says upper middle class, which used to be like 7% till almost 2005, is likely to go up to 44%. And one person shift to an upper middle class, his expenses go up by 8x. Yeah, so that is the main advantages that India has of the demographics. The third D is the demand. Yeah, demand wise also, especially premiumization. I don't know how frequently you guys travel to India, but you look at airports, you look at hotels, premium hotels, restaurants, all of them are always jam packed. Yeah, so that way, these three Ds are going to be there with India for next at least, if not 2 decades, but at least maybe next 10 years for sure. What is more exciting, guys, is that these three new Ds which have developed in favor of India. Digitization, you all of us know about the UPI payment that has led the entire digitization since COVID. Okay, so many of trades happen kind of thing on an electronic basis. So much of trade is happening on an electronic basis. The second thing is development. Again, so much of metros are getting developed. Almost 30 kilometers a day is getting constructed in India. The roads are getting constructed. I was just hearing Mr. Nitin Gadkari, who's our road and transport minister. He's saying that from this 30 kilometers, we want to go up to 45 kilometers in a day in next 6 months to 8 months. Okay, so many new metro trains are coming up in close to around 20, 18 to 20 cities. So that way, it's this two Ds are again kind of playing helping us India, but it's the third D, the diversification, which is the new D again, kind of a thing. Uh, we keep talking about China plus one, but actually, what is happening in India as well? Europe plus one is also helping us a lot now with the trade wars with US. Yeah, Europe has started. Say suppose Germany, France, everyone is kind of expanding their defense budget, the engineering capital expenditure budget. So because of this, a lot of this production will start shifting to countries like India. Of course, India could have done much better. Yeah, okay, but there are countries like Vietnam, Cambodia, which have taken the lead out there. But again, India out here is also one of the biggest beneficiaries. So three Ds which have been there with India for a very long time, but these three new Ds which will lead this next level of growth in India. But the issue again, yeah. So all of us again know about this. Yeah, the largest working population. Yeah, we have got stable government, and not only stable government, we have got a good central banker and good judiciary. Yeah, and a growing population. business-oriented policies. So all this is the reason why one should look at India. NRI has always do have a small exposure to India. I think this is a time to increase that exposure and also push your known ones, your clients to start investing into India. But the issue has always been, that India is a great opportunity. But there are many issues that an NRIs face when they want to invest into India. Me did spoke about some of the issues. One of the biggest issues is having a PAN card and a OCI card, requirement of a PAN card and OCI card. Now, if you're a second generation, third generation guy in Europe, you're not going to have a PAN card on an OCI card. And then the requirement of NRI savings bank account, NRE, NRO, you can have only one PS account, the number of signatures that are required to open the account, constant re-KYCs. Okay, the reporting is in INR. You invest into dollars, but the reporting is INR. Okay, and then the taxation hassle. So even all of us being CAs as well, but I could see a lot of queries were there relating to the NRI taxation as well when you guys registered. Okay, so all these issues are there. Okay, but now with Gift City coming in, I think a lot of these issues get resolved. Okay, so first in Gift City, you do not need a PAN and OCI. You do not need to open a bank account. Your account gets opened within 24 hours to 48 hours. So account gets opened, you fund the account in US dollar terms. Your reporting is in US dollar terms. The fund pays the taxes, so you do not have to pay the taxes as well. Okay, especially if you are coming from Luxembourg, and especially or most of the Europe, there is no tax on global incomes, so you do not need to pay any taxes because the taxes are being paid by the fund. Okay, so it is a very smooth onboarding process as far as you as an investor are concerned. Okay, so that is why I would strongly suggest that this is the time to look at India. Okay, even the most popular person in the world right now, Elon Musk, talks very highly about India. Yeah, so this is why I would strongly suggest everyone to start looking to invest into India. We have got a perfect vehicle for you. So we have launched a Cat 3 AIF, which is a Category 3 AIF based out of Gift City. The minimum ticket size is $150,000. It's a kind of an open-ended fund. So you can come in, you can go out anytime. Okay. Of course, whenever anyone invests, we always ask them, please invest with at least 3 to 5 years kind of an investment horizon. Yeah. But again, it's an open-ended fund. Yeah. It's a flexi cap portfolio wherein we are going to invest into large caps, mid caps, and small caps. All of these investments are going to be into listed equities only, no unlisted equities. Yeah. See, unlisted private equities, sometimes the opportunity seems to be huge, but in a country like India, you also need to be very careful, because exit sometimes becomes a very big problem. Yeah? So that is why we are going to limit our this portfolio to only listed equities. Yeah, and ideally we would be having around close to around 30 stocks. We have been running a similar kind of a portfolio on a traditional route, which is called as a PMS, wherein NRIs have been investing despite all the troubles. 40% of our AUM out there is to NRIs, and we have been able to generate good double-digit, high teen returns out there. Okay, so this is the product that we have. As far as taxation is concerned, again, the fund would be paying the taxes. Yeah, I want to repeat, it is not you that would be paying the taxes in this particular fund. Okay, Philip India Billion Opportunities Fund would be paying the taxes. The short-term tax is going to be 20%, long-term tax is going to be 12%, and of course there are certain cess, so that's why you see the number as 21.84 and 13.65. Yeah, and dividend and interest income is also going to be tax kind of a thing. Yeah, but despite all the taxation that you see, you would have another query that what happens uh, on an average Indian currency is depreciating by 3 to 4%, plus the taxation, plus the fees. What are the final returns that we are looking at? Because India is such a bright opportunity over last 10 years, 20 years, 30 years, on an average, India has been able to generate around 12 to 15% kind of returns. Yeah. And with hopefully with our active fund management and with such a large research team, our endeavor is to generate maybe close around 15% kind of a returns. Again, guys, please don't take me There's no assurance or guarantee of returns. That is the first slide Mihir showed you. But we are very confident kind of thing that India is the place, and we hopefully have the right set of criteria at Phillip Capital to manage the portfolio and to generate close around 15% kind of returns. So this is what we wanted to talk about. Yeah, of course, any queries, you can surely reach out to us. And now we keep the floor open for all your question and answers.
Thank
Hey,
you.
hi, this is Hemant here. I missed the initial part of the NRI taxation, and I don't know if your team would be sending or sharing the PPT or the
Sure.
recorded session.
Certainly. No, of course, we'll be sharing the PPT, and of course, Sagar ji and Anjani ji are there. I guess they can always share the recording as well.
Okay, okay. So yeah, I mean, I don't know. I mean, how would you share it? Like, do you have the participants list or name, or I can PM to Sagar ji, who had conducted, right, this
Yeah.
session?
So we are recording this session, and anyway, it will be published on the ICA Luxembourg page on LinkedIn, and Anjani sir will also circulate the link for that.
Okay, okay. So we can get it from LinkedIn also, you're saying. I see,
Yes, yes,
Luxembourg. Okay,
yes.
okay. Thank
Yeah,
you.
yeah, sure.
Just a quick question. So for us who live in US, so from an FBAR perspective, foreign bank account regulation perspective, will this be considered as our overseas investment or will it be considered as our domestic investment? Because at some point you mentioned that the investment would be in US dollars.
Yeah. So for you, it would be considered as a global investment. Yeah, because because the money would be coming into Gift City, yeah, which is outside of US. The reporting structure is in Gift City is in US dollar terms. Hence, and it is because it's the global currency. Yeah. So for you, it would be so because you are investing into India. See, finally the fund is going to invest into Indian equity markets. So that is what. Yeah. The only
Yes.
issue as far as US guys are concerned, of course, we spoke about taxation. US is a different animal. You would know as far as taxation is concerned. Yeah. But we'll be issuing K1 statements to US based investors as well. So, in case there is a difference between the taxation rate, it will help you in at least claiming back whatever the tax the fund has paid.
Okay, thanks.
I have one question on the taxation, same line, right? So I think earlier it was explained about the gift city, the way it helps, or kind of the features where it is regulated by not by RBI and SEBI, by the different body. But from the investor perspective, right? Let's say from the US, does it make any difference to us, in terms of taxability? As I heard, right, taxability is still going to be the same, the way we
Yeah.
would have our return from the foreign asset. And then due to the DTA, we can claim even in the individual account, right? If any taxes on the dividend, like in individual capacity when you invest, and if your TDS is deducted, you can always get that adjusted when you club your income from overseas. So is there any different tax treatment for the investment done through the gift city, or it is still the same for the individuals?
So as far as the investor is concerned, the taxation and the high level remains the same. Okay. But if you come through the traditional route of the normal NRE, NRO bank account, there are lot many hassles. One, to open the account, then to manage that account, to file your returns. Okay. Here in Gift City, that onboarding process is quite smooth. And since the fund is paying the taxes, you do not need to worry about it. Of course, we are more than happy to have you through the traditional route or through the Gift City route as well. Yeah. So as I told you, 40% of our clients on our PMS are through the traditional route. The NRIs are through the traditional route. But we are seeing a lot of people shifting from the traditional route to the Gift City route because taxation, as you rightly mentioned, remains same for both in both the cases. But it is the ease of the ease of investing into an Indian market that makes a lot of difference.
Okay, and for the tax purpose only, right? As you mentioned, fund would pay the tax, right? So let's say when you exit and when you make a gain, so that would be a capital gain in your hand, right? So I
Yes.
mean, from the investor's hand. So
Yes.
that would still be taxable, right, in India as well.
Yeah, of course, it would be taxable. So
Okay.
we would be paying these taxes, the short-term capital gain tax, the long-term capital gain tax, which such as an individual you would have to pay, kind of thing. But in this case, the fund is paying on your behalf.
No, sorry. So maybe I did not put it correctly. So all I see is right, the different short-term, long-term capital gain taxes are already paid. So when when we exit, or let's say like
Yes.
from the investment, so then there is no tax on that. That's what
No,
you're
there is
saying.
not. There
Since
is
Yeah, there is no tax. Yeah.
okay,
for
okay,
an
okay.
investor, there is no tax in Gift City or in India. Okay. The
Hmm,
only
hmm,
taxation that he would have to see is in his local jurisdiction. But again, if
hmm.
he's coming from US, then we would be providing him the K1 statement. Most of the other countries' jurisdictions have a exempt on global income. Yeah. So if you're coming from one of those jurisdictions, you don't have to worry about the taxation at even in your local country out there.
Okay.
So Nishit, I mean, this is slightly a departure from what we understand through mutual fund industry, right? Where mutual fund, whenever they buy, sell, they don't attract capital gain as such, right? Until the unit holder they sell or they buy or whatever, then short term, long term gains arise. Then
Yeah.
the taxation event occurs. But this is in contrast to that, this is quite different.
Yes. Yeah. So what happens in a mutual fund? Yeah, when the fund manager is, say, suppose he bought Reliance Industry at 100, he's selling at 120, he does not need to pay any capital gain tax. Okay. But when you are investing at $100 NAV and you are exiting at 110,
Correct.
you'll have to pay the long term or short term tax depending upon your duration on that $10. Yeah. So that is it. In this case, the fund would be paying taxes when I am buying a Reliance at 100 and selling at 120. Okay. But you do not have to pay any taxes when you're exiting the fund.
So when you buy and you sell, right? I mean, you pay taxes,
Yes.
but those taxes, as you said, ultimately will get reflected in the NAV of the PMS
Absolutely.
holder, right?
Yes.
Ultimately, it is the PMS investor who bears those taxes.
Yes. No, sir. In the PMS, the client would. So PMS is the traditional route wherein you come into India through the PAN card, the NRI bank account route. In that case, the investor would be paying the taxes. In Gift City, through an AIF structure, the fund would be paying the taxes, sir.
So just to add on to this, the Gift City AIF is very similar to the mutual fund in the sense it is a unitized product. So what you will be holding, sir, will be the units of the fund, which will be always, giving you returns on a post-tax basis. So when you are essentially exiting the units, or let's say exiting your investment and redeeming those units, so there is no incidence of taxation on you.
Right. Okay.
Yeah.
Oh, thanks for presentation, Rajesh here. Just a question, like if the global income is taxable in my resident country, then because the income was 100, just for example, or the profit, and then I paid tax like on that in India, and I got a net 90 in my hands, just for example, then how I will be able to declare in my country? I mean, how? So you will give a statement on that, right? That it was 100 and not 90
Yes.
as an
Yes.
income.
Yeah. So from
Okay.
our side, sir, we will be providing you all the statements.
Hmm.
Okay.
Hmm.
Again, if you're coming from US, we will provide you a K1 statement. Yeah, but there are some countries wherein maybe, so suppose I'm just giving an example, broad example. I am not sure
Yeah.
about it. So suppose Canada. Okay.
Hmm.
Therein there is tax on global income. Okay, and
Hmm.
they do not have a double tax avoidance treaty with India. Okay. So in that case, okay, the fund would be paying taxes in India, and you might have to pay taxes in Canada as well if you're not able to prove that okay that this is okay. But those cases are very few and far. Maybe out of the people NRI diaspora or foreign nationals who want to invest into India, most of the country have a double taxation treaty with India. Yeah, Middle
Okay.
East, suppose entirely Middle East, Singapore, okay, countries like Luxembourg, okay, all these places they do not tax global income kind of a thing. So
I mean,
Hi,
they tax it, but they give a tax credit also for the,
yeah,
I mean,
of course.
like,
Yeah.
for the payment. So taxation happens, but then you get the credit. I mean, I agree with you what you said. Yeah.
Yeah.
hi, Richa this side.
Yeah.
Thanks for the good question raised, and yes, thanks for the good presentation. Well, I will just pick up the last statement as you said on the question. If the country is having a double taxation on the global income, then it is fair. But like you picked up an example of Canada, I am based out of Europe, Estonia. And
Okay.
here, Estonia is not having a DTA with India. So in that case, how the tax flows? It's if I get like here the tax residents, if they get some income outside of the country, then they need to show the tax declaration and then get the credit of the extra paid taxes. So in that case, how the model works?
So in this case, ma'am, we would be providing you all the details that you what was your investment amount, what is that you have maybe made a redemption, what is the tax that on your particular kind of investment the tax has been paid by the fund. All those details would be provided by us to you. Okay. Then maybe in Estonia, you will have to kind of file when you are filing your returns you'll maybe can use this as a supporting. But again, we won't be sure about what happens into local countries, suppose like Estonia, how it is taken. They give you tax credit or they will maybe not exempt it. In that case, we won't be knowing those kind of details kind of event.
Uh, yeah, one more question, Ishit. So this
Yeah.
investment, right? I mean,
All right,
but
that is fair. I believe the sufficient information would be good enough for the countries which go for the global income.
Yeah.
But yeah, that answers my question.
Yeah,
Thank
but
you.
even say suppose, ma'am, that is what in my presentation, the opportunity in India is so huge. Okay. So even with maybe taxes, currency depreciation, then also if you're able to see 12-15% kind of returns, I think that and not much of a risk. Yeah. Of course, tomorrow if Trump wakes up on the left side of his bed, I don't know what happens. Yeah. Hopefully he wakes up on the 4th of April on the right side of the bed. Yeah, but otherwise, in most of the cases, I do not see a much of an issue. In fact, all this stress that is happening because of the Trump tariff, and in some way, it is going to benefit countries like India. I'm not saying India is going to be the only beneficiary. Globally, there would be many other countries that would benefit. But even after taxation, currency depreciation, all the challenges, if you're able to see 12-15% kind of returns, I think a lot of people are going to come and invest into India. Recently, over last 6-9 months, I've seen a lot of Europeans starting to invest into India big time. So that is where the opportunity lies.
Right, Nishitji, like you have rightly mentioned, tax is on the income, not on the capital.
Yes.
So, and the income growth is there in India. That's what we wanted to also tell that, like, guys, if your gross IRR return is like 20, 30%, then think about it, a 20% on 20% is like 4%. So your net IRR return is still 16%, which you don't get at the moment in the current market situations of Europe or US, which was the slide which Mihir shared from the S&Ps and the other markets, how they are performing. And also just to mention that we are all talking about all the public equity, all the tradable securities, not even the private equity or the venture funds or startups, something. So irrespective of the fact that the growth of the Indian market is based onto the certain demands, consumption, that the three Ds, Nishit, what you just mentioned, is the one where is attracting the global markets. You have been seeing BlackRock's, Vanguard, JP Morgan, State Street. Every other day, a statement is coming out from the India is the place for the next growth. So while we individuals, the retail investors would also want to be part of it, this opportunity through the GIFT City Fund gives us a lot of liquidative opportunities. While we can go with the normal PMS or the normal AIF route through the products which is offered by the various asset managers, but Gift City is still exploring out, and there is always a first mover advantage where people are still thinking to go whether these asset managers should open up their shops in Gift City or not. So while Phillip Capital could be one of the first movers, I feel that there could be other opportunities as well, which could give you an option. But please do look into your own research and talk to your financial advisors or the tax advisors to it, that which could be the right product. But again, income tax is on the income, and the India's growth story cannot be negated as such. So that's what I would just like to conclude here. But open for more questions. We still have 2 more minutes for this session. Please, guys, please ask your questions.
Hi, my name is Vivek, and my question is for Sagar. Uh, Thanks for the lovely presentation. What are the changes in the new income tax laws for HUF in context to an NRI who still has an HUF account, position in India?
So for HUF, see, we can have a one-on-one discussion on this. There are not many changes as such for the residency rule and all. But I have gone through your question as well. I think you had posted it before. So I suggest we can have a one call to explain the provisions for NRIs having an HUF.
Okay, thank you.
Yeah.
Sagarji,
Right.
Nishit, Mihir, can you share your contact details on the chat itself as well while the other participants are asking their questions?
Hi, just a quick question. For somebody who is a US citizen living in the US but has income in India, what is the best way to invest in the market in India?
So, ma'am, you're planning to invest your Indian income, or you're planning to get money out from US to India?
No, invest the Indian income.
Okay, so in that case, since the money is already in India, okay, I would strongly suggest that in that case, you can look at through coming through the traditional route. Of course, you are an NRI client in this case, but since your money is lying in India, you can come through the traditional route of either an NRE or NRO based on where the money is.
But are there limitations then in India to invest in
No.
mutual funds?
Mutual funds, of course, many mutual funds would not accept your investments because you are a US based investor. Okay. The restrictions are not because of the Indian regulations, it is because of the SEC and IRS regulations. Okay. But PMS providers, there are some boutique PMS providers like us who are MNC in nature because of our offices in US. We can offer you investment through a PMS. But mutual funds, I guess there are only a couple of mutual funds who accept US based investors. Of course, Sagarji out there would be an expert kind of a thing, which all AMCs allow.
Okay, great. Thank you.
One more question. Sorry to interrupt. Yeah, one more question. So we have the funds in the US, right, which are listed for India, iShare funds, basically, which are invest. So any plan for your team also to have such fund listed, or and the investment would be only in Indian equity, right? That's what I understand. It. The medium, small, and large.
Yeah.
So okay, but any plans you guys have to list your fund or float your fund in US market?
The US market is a very difficult market to crack. Of course, we have already got our fund filings with SEC, IRS, but it is only for accredited investor. For retail clients, I think it's still some time for us to launch a retail fund out of US.
Yeah.
Yeah.
And just to add on, so the gift city regime definitely provides, gives us the provision to start our exchange traded fund, because that would be equivalent of the iShares funds you mentioned. But currently, we are not looking at an ETF, if that was the question you had.
Okay, noted. Thanks.
Sure.
Guys, we give 1 more minute for the last question in the lieu of time. It's already getting late, but if you have more questions as such which cannot be covered here, please drop up your questions to the email or to us or to Sagar anytime, and then we will come back to you. But we already have Nishit, if you can share the contact details of Philip Capital as well onto the chat, that will also be helpful. And otherwise, we would like to give another 1 minute for the last question to happen. All right, great. So good, guys. Thank you for your time joining us, Nishitji, Mihir, Sagar. Thank you for your present here while sitting in India. We really look forward for more information and then more opportunities for us sitting abroad to see how we can be part of the India's growth journey. Once again, thank you very much for everyone joining in.
Thank you.
And
Thank you,
have a
everyone.
wonderful weekend.
Thank you.
Yeah.
Thank you.
I think it was one of it. I think it was by far our first session where we were addressing so many chartered accountants at once. So I think the flow of knowledge was indeed two-way. So, thank you so much for the initial insights, and always a pleasure interacting with all of you. So thank you again.
Thank you. Thank you, Anjali.
Thank you.
Thank you.
Thank you.
Bye-bye. We'll continue having more sessions on our NRIs and investments going forward. Thank you very much.
Absolutely, absolutely. Thank you.